Many traders struggle to identify a valid and high-quality order block, and may result in significant losses. So this video is everything about the order blocks. In this advanced tutorial, we will delve into the intricacies of order blocks, exploring their various types and providing detailed guidance on how to identify high-quality ones, rules, criteria, entry and exit models. If that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel. Let's get started with the major types of order blocks. The first type is the standard order block. In a bearish scenario, the standard order block refers to the zone corresponding to the last bullish candle before a sharp and substantial downward movement. The theory behind considering these zones as potential reversal areas is based on the belief that they represent manipulation areas formed just before a significant market movement. Traders view these zones as areas where a large number of buy or sell orders have been executed. Therefore, by using these zones in our trading strategy, we can potentially take advantage of the high probability of price reversal and change of direction when it reaches these areas. In this example, we see that, after the formation of the last bullish candle, the price experienced a sharp downward movement, leaving behind a significant inefficiency in the market. However, the price eventually retraced back up, filling the liquidity voids that were created during the downward move. As a result, the order block was mitigated, the price reversed once again and continued the downward movement. The second type of order block is known as the primary impulse order block. This type of order block occurs when the price fails to initiate a strong or significant movement after changing its primary direction. In a bearish scenario, the primary impulse order block is identified as the first weak bearish candle that forms before a sharp and significant downward movement. It represents market exhibited a lack of momentum in continuing its previous bullish trend, potentially indicating a reversal or a change in market sentiment. Let's take a look at an example. In this chart, we have a downtrend where the price created a bearish break of structure by breaking below the previous lower low, leaving an inefficiency behind. To identify the most recent order block generated by the price, we can focus on the first weak bearish candle that formed before the significant downward movement. This candle represents the primary impulsive order block, indicating a potential reversal or change in the market direction. It is an area of interest where the price may reverse when it reaches that level, providing a high probability trading opportunity.
Recommended broker is Longhorn FX. It's an ECN broker dedicated to delivering a superior trading experience to traders.
Third type is wick-based order block. In a bearish scenario, a wick-based order block occurs when the shadow or wick of the last bullish candle, or the first weak bullish candle, is greater than half the size of the entire candle's body. In this pattern, only the wick of a candle is considered as the order block, disregarding the candle's body. This manner provides an optimized and smaller zone, compared to the considering the entire candle size as our area of interest. As you can see here, price sharply pushed to the downside and created a series of bearish break of structure. So, it's clear that this candle located at the extreme is the first weak bearish candle, formed before the price created a sharp downside movement, but as you can see, the wick of the candle is greater than half of the whole candle. As we mentioned before, we should highlight the entire wick. This is our order block, instead of the entire candle size. Let's move on to the next order block type, engulfed order block. In a bearish scenario, a bearish engulfing order block occurs when the last bullish candle's entire body is completely engulfed by the subsequent candle, indicating a strong influx of selling pressure that overwhelmed the buying momentum, followed by a sudden and significant downward movement. In this example, we see a shift in the market dynamics as price breaks out of the structure to the downside, signaling a change of character from the previous uptrend. The candle we are focusing on is the last bullish candle formed before the bearish movement. Entire body is engulfed by the following bearish candle, indicating a strong bearish momentum. Upon closer inspection, it becomes apparent that the wick of this bullish candle is greater than half the size of the entire candle. This raises the question: should we classify this pattern as a wick-based order block, focusing solely on the wick as our area of interest, or should we consider it an engulfed order block highlighting the entire candle? In this specific case, it is recommended to treat it as an engulfed order block. Consider the entire candle as the area of interest. Let's see the next order block, the breaker block. Breaker block is a failed order block that has been broken through and turned into another supply or demand area on the chart. As you know, market could ignore the order block, supply and demand for many reasons, including a shift in market structure, being overvalued or being oversold, tapping into the higher timeframe key levels, or retesting key liquidity zones just below or above the order block. Invalid order block fails to reject the price, and price break through it and becomes a supply or demand level, which we call it as a breaker block. Breaker block is usually most effective when price break through it with large momentum candles with a tiny pullback to it. Let's see an example. As you can see, price pushed to the upside and has broken out this order block with large momentum candles, and also left great inefficiency behind. In the following we can see, the price eventually pushed back down to fill the efficiency, and also it's clear that price after mitigation of the breaker block, has sharply pushed to the upside. Also price ignored the standard order block which was located at the extreme. So let's move into the last order block type, mid-movement pivot order block. It refers to the formation of an opposite color candle within the midst of a strong bullish or bearish movement. This candle acts as a potential reversal signal. It signals the potential for a reversal or a temporary pause in the current market direction. The psychology behind this block is, we consider the zones as potential reversal areas where price has a tendency to reverse and change direction upon reaching them. They serve as important signals indicating a possible loss of momentum or a consolidation phase in the prevailing trend. Consequently, we monitor the zones in the market as potential reversal zones that require closer attention. Traders, we have thoroughly covered the major order blocks that frequently appear on real price charts, enabling us to develop a solid understanding of how to identify them. Now, in the next video, we will explore the entry models that can be incorporated into our trading plans using order blocks, and rules to apply these entry models for executing trades based on the insights gained from order block analysis. Stay tuned for part 2 of this video. Thank you for watching. Give this video a thumbs up to show your support, and subscribe for more videos.